All right. Now let's try to be able to give ourselves an example of a profit-taking maneuver and a buyback maneuver. Here we have pure gold. We have an uptrend. Now, we have a breakout condition from an area pattern we see here at the bottom, and we execute, let's say, a buy signal here. Now, I drew this over a moving average, the red one, which is a shorter-term moving average. I also laid out the RSI figure here in the bottom to give you a good sense of whether the stock is overbought or oversold or not. And I want you to be able to see a little of the indicators that it had. So clearly it goes up and down within the set band. Now, let's have a look at a few readings here. If you notice the RSI, the red arrows show you areas where overbought conditions were fleshed out by that indicator. And it all came because stock prices moved up very sharply. In this case, it went up here. In this case, it went all the way up here. And of course, in this case, it stretched all the way up, first from here, and then the second one from there. Now, I'm showing this to you because when you see the overbought condition, this is where it's time for you to say, all right, maybe I should sell a little bit. But since the uptrend here is still relatively strong, in a case like this, maybe 30% of your position should be okay to take some profits on. And then if the price settled down and you see either a consolidation or a whip back to support, you should look for an opportunity to be able to buy those things back. Where would those areas be? So for example, take a little bit of profit, buy it when it breaks out of this, since it's closer to support. Take a little bit of profit, buy back when it rebounds off your support. Here, take a little bit of profit. It decided to be able to consolidate for quite a number of months in this particular case, so you could have saved some money. You could have traded something else while this was consolidating. And now you're seeing the conditions that are showing a new setup, and it breaks out of that, and you can buy your stock back here, and you can take some profits either here and here, and wait for a new pullback to be able to handle it. Now, look what happened here. Now, in this case, the price fell back, but it broke through the trend line, and it also broke through your moving average. It did jump back above it a little bit, but not by a serious amount, and it only really amounted to a sideways move. That automatically gets me into a very worrisome condition because it's threatening that this main uptrend that I've been following here is now under threat. And if this uptrend were to break by more of a decline in prices, then it's time for me to get myself out of that condition. So here I would have sold maybe 30%, 30%, 30%, buyback, sold 30%. Here I would have waited before buying back, and if prices continue to break, whatever I had left, I would have unloaded it into that situation. And so this is where the profit taking and buyback condition should be able to present itself to you. Remember, you're only selling the position because you see an extraordinary gain in a very short period of time. You want to take some of that meat back, but you want to buy this back as long as the uptrend remains intact. And you will only liquidate the entire position when you see a change in trend or a drop of major support. That's the only time that you unload this. Okay, so let's talk a bit more about being stopped out. What signals can we use to be able to highlight those stop out moments? Well, a break of your trend line or moving average is a good indicator because that suggests a break in trend or support. Any breakdown condition is also something that you should look at. Now, let's have a look at these two conditions first, and I'll look at the third one into the next slide. Now, a trend line or moving average break. So here we have it. So we have an uptrend bouncing off support, bouncing off support, bouncing off support. So as long as you see all this very much intact, there's no need to be able to sell out your entire position. You can take some profits on the extreme conditions you have over here, but please buy them back when you see support rebounds from your trend line. Now, look what happens here. Your trend line cracks, the moving average breaks, and just before this happens, that tells you already a warning sign, and that says unload. And good thing that we followed this, because if it did that, you look what happened to prices. So it's very important. Now, if both of you, if you want confirmation from the two to happen, you can do that. You can say, I need my trend line and my moving average to break to be able to tell me to get out, if you want to be that fussy about everything. But look, at the end of it, whether you follow this or whether you follow this, it would have prevented any loss out of these 3 huge decline days that you've had. So keep watch of trend lines and moving averages. Remember, because they're breaking because trends are changing. It doesn't mean that that an uptrend breaking automatically means it's going to go down, because remember, there are three trends. It could go sideways, but remember, you're not buying a stock for it to go sideways. You're buying a stock because it's in an uptrend. And so if that uptrend no longer exists, I should be taking my position out and looking for another uptrend out there that should mark me up much faster than a sideways or declining market. A breakdown condition. So a breakdown condition looks something like this. So again, we do have an uptrend line here. Our uptrend line broke. So if you followed your trend line, you could have gotten out here. Some people, though, would be bothered because many times after a trend line break, there is this ability for prices to rebound, retest the high before actually turning the trend. And I explained that also in my 2 webinars ago when I said that area patterns normally do that, retest of the highs and lows after a trend line break. And so in this case, a consolidation pattern was built. But on this moment here, when prices ruptured through that floor, there should be no excuse for you to be holding that position anymore. Your trend line told you to sell. Now your area pattern told you to sell, and that major support break is a violation that we have to listen to. And look what happened to that stock afterwards. So please, any trend line break, moving average, or area pattern break are major support fault that should be able to narrow down or pulling that position out altogether because you're trying to safeguard whatever you've made so far. Now let's talk about this third type of stop out condition called a trailing stop violation. Now we will use this by also understanding marking out areas of clear support and what I call looking for last reaction lows. So let's have a look at it here. So we have a situation where Ayala Land climbing up, as you see. Now we do have a reactive trend. Prices break out of that, which a potential buy comes in, and let's just see a downtrend, recovery, retest of the low, area pattern being built, breakout came in here, so you look to buy. Now, we have an uptrending environment taking place. Now, how do we set up our conditions over here to be able to ride this through? So assuming we're entering somewhere over here, let's not look at some of the technical indicators we have or classical indicators to help us make an assessment of this. Okay. So the first thing I did is I just wanted to generate based on support and resistance alone, whether I can create a system to help me protect myself every time I enter the stock, and to see whether after every reaction, whether I can raise my support into the next level to protect whatever profits I make. So if I bought this stock here, stock price goes up. Now remember, I will not sell this unless my support is broken. After this breakout price itself is support. Remember, an area of resistance once broken becomes support, the reversal of roles. So as prices breach, you buy. It corrects. It does not go back below the breakout price. So that means you don't sell this. Then an area pattern is made. It consolidates for a while, winds up, breaks out again. Once a breakout takes place, I will now move my support area from here, and I will now move it into the next level where prices broke away from. Now a new consolidation is built. This is now my new support level. It consolidates up and down, up and down, up and down, and eventually it breaks out from that new range all over again. Once it breaks out, I will now generate this area. It used to be resistance. I will now use it as support. And now prices attempts to make a reaction, and it doesn't break that supportive element yet. So far, whatever I bought here, I have not gotten stopped out because the support areas have not broken. This has held, and so far this is holding. Now, prices rupture over the previous high, so this used to be resistance. I now use this as support, and prices climb once again. And if you notice what happens here, eventually the stock price does break my support area, and it's in this case, I liquidate my stock position. So here's what we call adjusting or trailing my stop. I'm raising it at every opportunity I can whenever I spot a new support so that I can protect whatever profits that I've realized so far. Now, you can also use a system like this. Now, I call this looking at the last reaction lows. Now, what that means is this. Into an uptrending situation, I will simply look at every upswing, where was the last correction it made? What was that last low? I'm assuming it didn't break my original support area. And after prices rally, I will mark off that area as my new stop. In other words, to me, this is major support now. It winds up, breaks out, Okay, and I can just keep doing that, racing and racing. In fact, you probably could have done it here as well. The prices went up, went to a new low, went to a clearly low here, broke out again, raise your stop to this previous low, pushed up again, corrected, pushed up, raise your stop to this last reaction low, again here, reacted to this level, raise your stop into this area, and the minute this breaks this low here, I sell my position. Now remember, I can't stress the importance of adjusting your stops along a trend, because if I were to just say I buy this and as long as this doesn't break, I will not sell, what happens if this goes all the way up here? And in this major correction, let's say it's in this major correction that it actually breaks through that to that low later on. So what was the whole point of trading all of this, where you could not even keep the money that you made? Right? So adjusting your stops upward becomes very important. This is how you pocket your money. You put a safety net to the profit level so that it's not taken away from you. You've worked so hard for it. Put it in your pocket. And this is how you create the safety net to do that. Also, trend lines can also be used. For example, if I bought over here, a breach of the trend line can tell me to get out. Right? So I take my position out first. And why? An uptrend became a sideways trend. Now, in this sideways trend, it broke out from here. It generated a new advance. And so now I can now start drawing a new trend line. If I'm short term, I will just make it this advance. If I'm more longer term in my orientation, I can draw a new trend line which connects two major lows and use this as my selling instead. But assuming I'm a short term trader, I will follow the lows that I see. And thus, on a break of this level here, I will sell my position. So that means in these swings that you see here, I would have bought here, sold here, bought the breakout here, and sold the breakdown of the trend line here. And that's how you adjust your stops upwards so that you can protect the profits that you've made.